Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we're going to talk about cash flow and risk flow attributes of a direct writer captive. So much like a fronted arrangement, the employer still has two cash outflows with a direct writer: premium payments and capitalization. Capitalization is different than collateral in so much as capitalization is the investment in the captive. So when the employer capitalizes their captive, that becomes the employer's basis within the captive insurance company. Okay? Cash from both the capital and the premium are deposited in the captive insurance company. As compared to a fronted arrangement, premiums and collateral are held at the fronting carrier. Okay, so employer 1, 2, 3, 4. This is one arrangement where multiple employers own or participate in a group captive that is issuing a policy directly. So in this example, employer number 1 pays premium to the TPA, and then the TPA remits those premiums to the captive. And then in exchange for those premiums, the captive will issue a policy. That's counter to a fronted arrangement where the employer will pay ultimately to the fronting carrier, and then the fronting carrier will issue the policy. Now, some arrangements, as in employer number 2, the captive manager can serve as an administrator. Therefore, the captive manager may receive or collect the premium and then remit the premium to the captive. Or there may be an arrangement where the employer directly pays the captive its premiums, whether on a monthly, quarterly, or annual basis. Whatever arrangement is made, the captive is the holders of the cash, not a fronting carrier. So the other arrangement is, what if you're an employer and you have your own captive? Many times this is called a single parent captive, whereas the captive, the employer is the parent of the captive. Just like over there, employer number 1 pays premium, the TPA will remit the premium to the single parent captive, and then the single parent captive will issue the policy to the employer. Okay? In this arrangement, there is a pooling that generally happens to leverage the risk from all of the captives. Okay? A risk pool is where each captive cedes to the risk pool, and then the risk pool does its job and duties, and then will allocate back to each of the captives the risks. Okay? Now we'll talk about that down here, but for this example, most of the time, single parent captives combined and work together through a risk pool. Okay? Now, 2022 treaty year, January, February, March, April, all of these cash premium payments are deposited into the captive, whatever model. And then when the policy expires, that's when the final settlement happens. The underwriting profit settlements generally happen faster in a direct writer than a fronted commercial insurance arrangement. Generally. Okay. Risk flow. Let's again assume that the captive collects $1 million. Employer number 1 contributes $200,000 of that premium, and then subsequently has a $100,000 loss. This all boils down to $200,000 of underwriting profit. Now, What's in question is all of this, the risk shifting and sharing, should be expressed in the participation agreement. If it's not expressed in the participation agreement, it may be in the membership agreement or the subscription agreement, but you want to understand how claims are shifted and shared. Is it a first dollar risk pool, or are there multiple fund layers? Okay, you'll want to understand that. Now, the other option is, let's say this single parent captive cedes a $100 claim. The risk pool is a separate entity, and it has its own duties and tasks, which have an expense to them. Now, the risk pool could be owned by a third party, or it could be owned mutually by all of the single parent captives. So, let's assume for a minute that it's owned by an independent entity, and the cost to do its duties is 5%. So that means single parent captive number one submits a $100 claim, the risk pool does its duties and adds its cost to that $100 claim, leaving a claims cost of $105. That $105 is then retroceded back to each of the cells, each of the single parent captives. Okay? Now, this arrangement is expressed in the reinsurance and the retrocession agreement. So if you're looking to get into this arrangement, you'll want to fully understand the retrocession agreement. Okay? So, I hope this was helpful. Lots of activity going on here between the fronted arrangement and the direct writer, and we've introduced some new terms. Reinsurance agreement, retrocession agreement, participation agreement, those are all considered core structural documents that we're going to talk about next week. So until then, have a good week. Bye now.